Hello, this is Peter Stradham. Thanks very much for taking the time to view this presentation. What I'd like to do is to give you a really high-level overview and some simplistic pointers on how to structure an effective family income protection plan. The objective of this presentation is to get you thinking about your family income protection plan and the fundamentals of putting an effective plan together, and to guide you in achieving financial independence for your family. The other thing that I'd also like to point out is the absolute importance of a will, and whilst I don't intend going into any great amount of detail on any of these issues, just to highlight the principles involved. Let's ask a couple of questions. What happens if a breadwinner dies and the home is not paid for, car is not paid for, has other outstanding debts, still has children to maintain and educate, spouse has to continue working or go back to work, and doesn't have an effective will? Let's have a look at some of the goals in putting together a family income protection plan. First thing you want to do is to make sure the debts are paid. So that would include making sure the home is paid for, making sure that the car is paid for, and that there are any other debts that could pose a threat to the survival of the surviving children and family. So those debts all need to be paid off. And to ensure that children can be maintained and educated. When you've got young children and the wife is staying at home and taking care of the children, if something was to happen to the breadwinner and there wasn't enough money to provide an income, that would obviously involve the wife having to go back to work, and then it's putting children in creches and nurseries, and these are things that you really don't want to do if they can be avoided. In terms of reviewing your will, first of all, do you have a will? If you do have one, how current is it? When was it last reviewed? And does your spouse know where to find the will? You need to, in your will, also pay attention to securing minors' inheritances. If there's a surviving spouse, perhaps that's not such a big issue, but in the event of simultaneous death or death with a short time period between the first person dying and the second, then there could well be a problem in terms of minors' inheritances and appointment of guardians for minors. Minors' inheritances can be protected very simply, merely by making provision for the creation of a testamentary trust in your will. Like I said right up front, I don't want to go into too much detail around these issues because they are fairly complex topics all on their own. I'm merely pointing out some of the contingencies that you need to pay attention to. You would obviously also need to appoint a suitably qualified executor. Many people are put off by the fact that executors can charge up to 3.5% plus VAT on the value of the assets of an estate. So what they do to try and save this is to appoint someone, a family member or friend, and more often than not these people are not suitably qualified, and this can result in unnecessary delays in actually getting the estate wound up. In conjunction with this, you also need to do an estate liquidity analysis. Very simply, an estate liquidity analysis involves determining what your assets and liabilities are, what you own and what you owe, what needs to be paid off, what assets would you like to be retained, and what assets can be sold. What is the extent of your life assurance and investments? Often people, once again, and it is prudent planning to have beneficiaries appointed on life assurance policies. That would mean that the money coming out of the life assurance policies then circumvents the executor, and you don't necessarily have to pay executor's fees. But the problem then is you end up cutting your nose to spite your face in a way, because you may well find that the estate needs cash to settle debts and various estate expenses, but the fact that you've appointed beneficiaries keeps the money out of the estate. Then the executor has to go back and ask the beneficiaries to pay money back into the estate so that debts can be settled and the estate can be wound up. You need to also just pay attention to any retirement fund group life benefits which you may have at work, and there you need to ensure that there are beneficiaries appointed. And then you also need to consider in the estate liquidity analysis estate expenses, which includes outstanding taxes, it includes the funeral costs, it includes the executors' fees, and in some instances, for the bigger estates, there could well be estate duty, depending on how the estate is structured. Once again, talking about estate duty and structuring of estates, it's a very complex field, and I'm not going to venture into that territory for the moment. Once the estate liquidity analysis is done, and one has determined then how much cash remains to be able to provide an income, to determine in fact how much capital is required to provide an income, one would have to look at the spouse's current age, the amount of income that the family would need to be able to live every month, and the age to which that income is required. If you've got a spouse, a wife, for example, who's only 35 or 40 years old, you could well need to plan to 75 or 80. So you're looking at a 40-year period in which income needs to be generated. And once you start looking at creating income and taking care of income requirements, you also need to take into account inflation and at what rate that income should escalate. And it actually gets quite scary once you start doing these income needs analyses, should I say, in terms of how much capital you actually need to be able to provide the necessary income. In addition to that, one has to pay attention to capital needs. And the capital needs, some of them I've already mentioned. There's all the liabilities or debts in the estate duty and executors' fees. Those are the obvious things. But then there could well be special bequests in your will where you've left someone other than your family a bequest, 50, 100 million rand, whatever. That has to be paid out as part of the estate expenses. So there needs to be enough capital to do that. And then the normal, well, when I say normal day-to-day stuff, there will be capital requirements for your family in terms of replacing motor cars, perhaps going on a holiday, which I suppose could be regarded as a bit of an indulgence, but these are the kind of things that you need to take into consideration. I'm merely stimulating some thought processes here, and needs and priorities will differ from one family to another. And then, of course, there's children's education. I don't know that I have to labour this point either, but education is becoming extremely expensive. And if you want your children to have a decent start in life, then you need to be able to provide the capital to ensure that that does happen. There are obviously going to be a lot of questions, once again, that have popped into your mind, having just listened to some of these pointers that I've given you, and I would strongly suggest that you consult with a suitably qualified and registered financial advisor. Thank you for viewing the presentation, and I trust it's been thought-provoking and useful.